Hello, I'm Michael Andersen of Andersen Wealth Management. For many years, most investors believed that a buy and hold strategy for investing in the stock market was the wise thing to do. After all, it worked in the past. Unfortunately, the last 10 years have proven this strategy to be unreliable. This video will discuss issues related to the market and how planning today could affect your retirement tomorrow.
If the decade from 2000 to 2010 taught us anything about investing, it taught us this. The stock market doesn't always go up over a long period of time. It also taught us two other equally important lessons. First, that buy and hold is not always a good strategy. And second, that asset allocation, the blend of bonds and stocks, doesn't always work in a financial crisis. Let's begin with a basic principle. Investing during retirement, and the years just before retirement, is something that requires great care, and you, the client, should ask some questions. First and foremost, every individual investor should ask this all-important question. Does my advisor have a legal obligation to act in my best interest? Surprisingly, most people assume the person they have entrusted their life savings to is held to a fiduciary standard, and that is not the case. A Best Life magazine article entitled "The Best Life Guide to Choosing a Financial Advisor" talks about a man who had built up $2 million in savings and hired a prominent national brokerage firm to manage his money. It goes on to tell us he lost $900,000 over 2 years. Despite his worried phone calls, he was assured by the brokers that everything was just fine. Well, eventually he sued to try to recover his losses and won $10,000. The article tells us he learned a very valuable lesson during the process, one that can help you today. He learned his broker had no legal obligation to act in his best interest. In fact, it goes on to say that if the broker is faced with two investments, one that is clearly superior and one that is not as good but will pay him a larger commission, there's no law to prevent him from selling a lesser quality investment. The difference between an advisor and a broker is the advisor is held to a fiduciary standard, always putting the client's interests first. The broker is held to a suitability standard, a far less stringent standard, allowing them to put the company ahead of the client. Now, not all brokers operate this way, but many do. So, now that you understand the difference between advisors and brokers, let's talk about the recommendations they make. The first thing to point out is there is no such thing as a perfect investment. In fact, if anyone ever suggests such a thing, that suggestion should be met with a good deal of skepticism. The truth is, every investment has advantages as well as disadvantages. For instance, if you buy the right stock at the right time, you could make tremendous profits. However, if you purchase the wrong stock at the wrong time, you could lose a lot of money. Unfortunately, the last decade offers plenty of examples of retirees and those about to retire who have lost their life savings, or they suffered losses large enough that their retirement dreams suffered. This brings us to a key point. There are three phases of money you go through in your lifetime. You have the accumulation period during your working years, then preservation, the years right before and during retirement, and finally, the distribution phase, the time during retirement and also after you pass away. Preservation is critical since this is when you retire and your nest egg must last a lifetime. It's the number one fear of retirees today, outliving their savings and running out of money. Distribution is equally critical, how much to withdraw during retirement, but also who will inherit your estate and how much will legal fees and the IRS take. In many cases, retirees are conservative and are looking to scale back risk. Yet the brokers that they are working with have them in moderately aggressive to aggressive investing with very little of their savings in a safe and secure position. Again, the 10 years from 2000 to 2010 taught us that more risk doesn't always mean more returns. In fact, during that time, the major stock market indexes were negative. And adding inflation over that decade meant most retired people lost a significant amount of purchasing power when they could least afford to. What this illustrates is that focusing on fundamentals is more important than ever. It also should cause you to look at Wall Street with a skeptical eye. Despite the horrible losses suffered by their clients in 2008, Wall Street executives and brokers were paid huge bonuses in 2009. How huge? A Forbes magazine article from August 9, 2010, entitled "Winning on Wall Street Beat the Street," tells us that according to the New York State Comptroller, in 2009, long before many of their clients had recovered their losses, Wall Street, with the help of $700 billion in taxpayer bailouts, capped the year off with $20 billion in bonuses for itself. That would equal a bonus of $124,000 for every investment banker, analyst, and secretary. It certainly seems their clients' best interests were not the first thing on their minds. Considering fundamentals, you can learn from a couple of examples of when things went bad, because most likely, the fundamentals were ignored. Consider the stock market in the late 1990s. Many people were investing in things they didn't understand, and the market saw huge gains. Unfortunately, from 2000 to 2002, the market crashed. The S&P 500 lost more than 40%, and the NASDAQ lost more than 75%. Another example is the real estate market from 2002 to 2007. People thought real estate would always go up in value. They were buying houses with no money down, interest-only mortgages, adjustable-rate mortgages, buying houses just to resell in a couple of months, a practice known as flipping, and the market crashed. In fact, the whole system almost crashed. But the bottom line is, some basic fundamental principles were ignored, and many people paid a great price for it. A retired couple profiled in a February 2009 article from Consumer Reports magazine entitled "Rebuild Your Nest Egg" said, "We did what everyone says you're supposed to do. It worked for a long time, but it's not working anymore." The article tells us the couple downsized from a house to a condo, postponed vacations and major purchases, and they cut charitable contributions and birthday gifts to their 10 grandchildren. It certainly seems this could have been avoided. These people paid for bad advice, and the cost was their retirement lifestyle. A fundamental principle many advisors recommend is a simple concept called the Rule of 100. This has been around for a long time and is known by most every advisor and many consumers. The brokerage world has advocated this model to some degree for years using a term known as asset allocation. This formula uses a mixture of bonds, bond funds, and stocks, or mutual funds, and was thought to be a very sound philosophy until the crisis of 2008. That's a time when almost every asset class suffered a loss, and for many investors, even the part of their portfolios they thought were safe saw significant losses. In fact, a Wall Street Journal article from October 13, 2008, entitled "Investors' New Mantra, Buy and Fold," summed it up very well. It said, "Small investors are frustrated that everything they've been taught has turned out wrong. Diversification isn't working, and a buy and hold strategy has been a waste of time and money over the past decade." That brings us to an important topic. You should look at your account statement. And if you own mutual funds, ask yourself this critical question: why do I own these specific funds? There are several thousand mutual funds to choose from, so you should ask, why did your broker recommend the ones he sold you? Are they run by world-class money managers that have consistently outperformed their peers? Or were they the funds his company makes the most money to sell? Unfortunately, many times the retiree's portfolio reflects the business model of the broker rather than the best interest of his client. Another thing to look at: do you own a loaded fund? That is, do you own an A, B, or C share mutual fund? If so, your broker is restricted from moving your funds to potentially better performing funds due to churning laws. This means they cannot continue to earn new commissions from the same clients. Inside many of these funds, there is a hidden fee known as a 12b-1 fee that most people don't know is there. A Kiplinger's article entitled Your $12 Billion Burden states that investors pay fund companies $12 billion a year in 12b1 fees. The article goes on to state that's an awful lot of money changing hands, especially when most of those who do the paying don't understand what the fee is or what it goes toward. The question you should ask yourself is, do I have these hidden fees in my portfolio? And how much are they costing me if I do? Many advisors recommend that a client should own no-load funds and simply pay a fee for their advisor to manage their accounts. This aligns everyone's interest and gives the advisor freedom to truly manage a client's funds. A great example of this could be your own portfolio. Are all of your funds invested in one fund family? It's highly unlikely that one fund family has the best funds in every category, yet your broker may have you invested that way. Here's a good question to ask. Is this in my best interest, or is it reflective of my broker's business model? Very candidly, if you look at your brokerage statement and you own mutual funds and they are A, B, or C shares, many advisors would recommend a portfolio review and comparison. You may find you have outstanding mutual funds and there's no need to make a change. Or you may find you own mediocre investments that can be improved upon, giving you a much greater probability of a successful retirement. A critical question to ask yourself is this: do you have a plan to deal with volatility in the future? From 2000 to 2002, the S&P 500 lost 43%. From October 2007 to March 2009, it lost 56%. Does a buy and hold strategy make sense in times like that? Or does it make sense to have an advisor whose interest is aligned with yours and the focus becomes preservation of capital in times when the market goes south? A buy and hold strategy means you ride out the roller coaster and wait for the market to recover. Why does a broker think this is okay? Simple. It's their business model. Those 12b1 fees we discussed earlier, if you go into a cash position during a crisis, the 12b1 fees stop. Let's think about the future. There are 75 million baby boomers starting to retire, and they will be doing so for the next 20 years. Please take a look at this website, usdebtclock.org, and you can see Social Security and Medicare combined are underfunded by over $100 trillion. Add on our national debt, and we can see potential trouble in the future, potentially higher taxes, lower benefits, and maybe even greater volatility. What plan has your current advisor or broker brought to you to address these concerns? Many advisors feel that the old rules don't apply to investing in retirement any longer. A greater emphasis should be on planning for greater income in the future due to cutbacks in social programs or even inflation. The bottom line is this: if you had a serious health concern, a second opinion is often encouraged. Also, many people have more than one doctor: the family doctor for the everyday concerns, but then the specialist for more complex issues such as a heart problem. Interestingly enough, most retirees only have one financial advisor and almost never seek a second opinion. Shouldn't you get a second opinion on your investments? Your retirement savings represents a lifetime of hard work and sacrifice. You want to make sure that you're in the best position possible so you can have a financially successful retirement. The time spent getting a second opinion will provide you clarity and understanding. You may find you own outstanding investments, and your advisor or broker is doing a great job. In that case, there's no need to make any changes. Or you could find you have underperforming investments, and maybe the person managing your money is not putting your best interests first. Perhaps making some changes now could make a significant difference for the remainder of your retirement and keep you on track for a more secure financial future.
We've covered many complicated topics in this video. It can be a lot to digest in one sitting. I would like to suggest this. Contact my office for a free consultation. We can meet, review your portfolio, and discuss how these issues can affect you. It's your retirement, so make every effort to understand your options.